Is financial repression growth an accident or a systemic process creating ongoing pressures for savers like yours? You are a saver building wealth steadily, allocating to bonds and cash, believing safe assets will preserve purchasing power. But what if financial repression contributes to mechanisms that erode real returns and favor debtors? Today, we're analyzing financial repression, the macroeconomic mechanisms of low rates and inflation effects that influence savers through purchasing power and policy transmission. The data reveals the truth unmistakably. Real rates negative for decades in developed economies, with savers losing 2 to 4% annually to inflation above yields, while government debt service costs drop in real terms. Stay with me to the end. This isn't isolated events. Sir, it's the clear analysis and path to financial independence that could help navigate these pressures. The explanation provided and experienced by savers like you is that low rates are stimulus for growth, safe yields for conservative investors, with inflation transitory and contained. That negative real rates are temporary, bonds remain safe haven. But look closer. Why do periods of high debt coincide with suppressed rates and above-target inflation eroding savings value while reducing real debt burden? Why do emergency policies become permanent? Why does financial stability raise questions when yields fail to beat costs? Insight 1. The system doesn't need high taxes to fund debt. It only needs rates below inflation to transfer from savers to borrowers over time. This isn't isolated events or unavoidable policy. It's a systemic process rooted in repression mechanisms that influence saver outcomes. Financial repression isn't accident. It's the mechanism that affects saver returns through policy transmission. Post-World War II. Classic: rates capped, inflation high, debt over GDP fell. Modern version: post-2008 ZIRP/NIRP. 2020's continuation. The result: savers subsidize borrowers, real wealth erodes. For savers believing bonds safe, the reality is clear. The mechanisms have been in place, influencing outcomes over time. Intriguing, yes. But who are the key players in this repression process? Who are the key players in this repression process? So you know you're not missing the bigger picture. It's not abstract economic necessity alone. It's central banks and governments who shape outcomes through rate policy and money creation. Picture them as established participants in the financial system, managing liquidity while you, holding bonds and cash, navigate the resulting pressures. The process works through negative real rates. Policy keeps yields low, inflation runs above, savers lose purchasing power, debtors gain. Deep dive. Post-2008. Real rates negative 70% of time. Savers lost trillions in real terms while debt/GDP stabilized. Real-world impact. Pension funds reach for yield, take risk. Retirees extend working years. Families cut spending while policy supports growth. It's continuing. Current signals rates higher for longer rhetoric, but inflation sticky. Real yields negative again show process ongoing. Saifedean Ammous notes, repression taxes savers to fund state. Lynn Alden notes, negative rates are hidden wealth transfer. Insight 2. Repression doesn't require overt seizure, it only needs sustained negative real rates to extract gradually. History's pattern is clear: 1970s stagflation repression, 2010s ZIRP repeat. These players shape outcomes as saver wealth faces sustained pressure. But understanding the process is the first step gaining clarity. Now, explore the mechanisms at the core financial repression process, so you see exactly how it affects savers building patiently. It starts with debt levels. High borrowing requires low rates, inflation allowed above targets. Cycle continues. Negative real yields suppress saver returns, reduce real debt burden. Visibility activates. Costs rise, purchasing power falls. Institutions get cheap funding, leverage. Savers pay with erosion, timing later. Everyday impact. Bond yields 1 to 2%, inflation 3 to 5%. Real loss compounds. Cash savings melt slowly. History shows pattern. Post-World War II, Repression cut debt over GDP 50%. Modern version, post-GFC. Current signals indicate continuation. Debt/GDP highs, rate cuts delayed, inflation persistence. Insight 3. The system doesn't require confiscation to punish savers. It only needs policy to keep real rates negative long enough. Lynn Alden notes, repression is default when debt high. Milton Friedman, inflation is taxation without legislation. Insight 4. Wealth isn't protected by safe assets. It's eroded when yields fail to match expansion. The process isn't isolated, it's systemic, influencing saver opportunities over time. Think of it as silent flow, your prudence navigating broader currents. But here's the pivotal shift. You don't have to remain affected by this financial repression process. Stop navigating as part of traditional current. Adopt the independent mindset. Understand the mechanisms, then position strategically. Conventional approach, bonds for safety, cash for liquidity, leaves you in the flow, your real wealth influenced before fully realized. Redirect instead, question every low-rate benefit narrative. The clarity comes realizing yields suppressed post-debt eras gain independence, auditing exposure to negative real rates. Insight 5. Protection isn't chasing yield. It's owning assets outside rate manipulation reach. How much savings in yield-suppressed assets? Shift to independence. Preservation outside processes reach. Your history shows affected stay in current, independent thrive, preserving value across cycles. Practical step. Minimize repression-exposed holdings. Prioritize hard assets resisting policy transmission. Insight 6. True saver independence isn't timing policy. It's allocating where repression can't touch. You're no longer in the flow. You're the one charting course in manipulated waters. This isn't avoidance, it's pure clarity. You're positioned to turn mechanisms to advantage, emerging stronger from pressures. This is your initiation into true clarity. The deliberate path to financial independence from financial repression mechanisms affecting savers. None of this is financial, investment, or trading advice. It's purely educational macroeconomic analysis for awareness. Always do your own research and form your own conclusions. Bitcoin is digital gold, limited to 21 million coins forever, halving every 4 years. No one can print more. And impossible to confiscate like 1933 gold. History has proven it outperforms every traditional asset class during fiat stress cycles, with multifold appreciation post-halving, such as over 10 times gains after the 2020 event amid unprecedented printing. The 2024 halving cut new supply issuance in half again, with 94% already mined, making it increasingly scarce over time, the only asset truly immune to inflation by design. In eras of financial repression like today, this fixed supply property has positioned it as the ultimate tool for wealth protection, preserving value when everything else erodes. Start your initiation. Read The Bitcoin Standard by Saifedean Ammous. For the fiat parallels that will blow your mind, or The Sovereign Individual by James Dale Davidson, mapping the shift to individual sovereignty. Follow thinkers like Ben Cowan for cycle data, Lynn Alden for macro signals. Actionable, self-custody wallet, consistent dollar cost averaging into Bitcoin as your repression-proof anchor. This is the key to viewing money as your servant, not master. If this analysis has brought clarity, the drive to secure true independence commit now to the next layer. Subscribe as your mark of joining this community of financial clarity seekers decoding the system together. The next insight is waiting.